For now, despite AI, you still have to eat. And then we're going to look at Nomad food stock. Nobody cares about food anymore because AI will change that too, and therefore the stock is down 70% over the last 4 years. However, the PE ratio is not 800, it's just 8. The dividend yield is 5%, the buyback yield is higher than 5%, which leads to a 10% return or higher on food. Let's discuss the business, the risk and reward, the financials, put it into our quadrant, intrinsic value, and then how does it fit my portfolios. You probably know this is the ice cream from Croatia, other brands sold around Europe, bastoncini Findus, so things like that. They have had their ups and downs over time. There are these cycles in the food industry, but the trend has been positive for a while for frozen, excluding ice cream. The trends they are banking on: convenience, value, they say sustainability, but it's better to have their own garden, but okay. Over time, if everybody starts eating frozen food like the US and the UK, well, there is still a lot of room for growth, but when you look at this, Switzerland and Bosnia are the leaders. That's a combo. But no worries, maybe if the trend goes to this, that would be something different. Okay, Bosnia I understand, Switzerland, Netherlands also very interesting. And then here is the trend here, but I would say, let's say, flat. I'm not going to bet on more frozen food being eaten. Now, innovation, percentage of revenue, they are developing new things. Of course, everybody is now protein, protein, protein. Everywhere is protein, but that's the new trend. 2 years from now, there will be something else, things like that. If we look at the history of the companies, it was founded in 2014, hedge fund managers founded it, acquired Igloo Group, and then also Findus went public, acquired other companies, pizzas, Goodfellas, Aunt Bessie's, things like that. Let's look at the last earnings. Well, the last earnings have been a little bit subdued. The growth has gone, and you can see organic growth contracted 1.1%, gross margins contracted 310 basis points, and when things contract, then stock markets panic, sell the stock, and even if their share of the market has had its ups and downs, then still the stock is down. And yes, there is competition from private labels, Aldi's, Lidl's, things like that. It's the same frozen fish pretty much. So that brand power over the last 5 years is disappearing. Cheaper options there are when you go to the store, so that's also a trend that we must consider there. But again, on a free cash flow yield of 10%, no matter what, takeover potential, things like that, it's also something to think about. So organic revenues down, lower margins, but still positive, still earnings per share, still cash flows there. So not a huge difference, not a terrible difference. And you see the earnings are there for the P ratio of 8. It was higher earlier, but okay, they say the weather was an issue, a little bit on pressures, on costs, on inputs, things like that, and of course, competition. But no matter that, they have repurchased 100 million euros of shares and paid out more than 400 million euros of dividends, and that is just in the first 6 months of the year. We'll later see they added another 30 million just in July, I think. Seasonal factors, they say that that's because the lower cash flow as they build up their inventories for the winter. Challenging year, but there must be a challenging year for the stock price to be down. If not, you would be paying full premium price. Let's look a little bit at the financials. If I look here, operating income has been growing. We are just seeing this decline for the last year and now in the first part of this year. But if you look at constant growth over time, 5%, EPS 8%, there have been some acquisitions, we'll discuss that also later. You can see here the revenues, slow and steady growth, net income, growing, thus they are creating value, and they have bought 25% of the company in the last 5 years on top of paying a good dividend. So when you go there, you are buying the cash flows. The key is there are significant intangibles as they acquire the right to sell those businesses in the specific countries, so a lot of acquisitions that increases goodwill. Acquisitions, maybe not that much here, but also push up the debt, which is 2 billion euros on EBITDA. That's 4 times EBITDA, 2 billion in equity. So that's also something to think about. This is a little bit stretched and always a risk because you never know what can happen, but that is always a certainty. If we look at cash from operations, 400 million per year, steady there, going higher. They have some capex, they have had some restructuring costs, things that they are working on, new strategies, things like that. That also has to be counted in, but they are repaying that slowly and steadily, repurchasing stock at a heavy pace, and they have introduced a significant dividend. When you sum all things up, if they go back to growth, the stock will go higher. If they don't go back to growth, let's say they just stagnate, which is blasphemy for Wall Street, this makes it already very interesting even to accept if there is stagnation. And then there is always the, let's say, margin of safety that someone will buy them out in case things get worse. Their targets is to return to growth, to improve their free cash flow. They have 3 pillars how they're doing it. Brands reinvesting, marketing, savings, and things like that. We'll see whether that will be the case or not. For that, it's good to look at the analyst's perspective. There was recently the Barclays annual conference, which has had great inputs. Andrew Lazar asked questions. How sure are you that you're going to reach your targets because you have significantly lowered your previous projections? The answer is a little bit more vague. More savings, okay, improvements, marketing, hopefully things will turn on the input side. Then again, you need to model, you need to value, are these savings real? And if so, where they are going? The management always tries to say something because even they don't know. You can't really predict what will happen in the future. And then also capital allocation. Strong free cash flow, that is something that you are getting with this business. And then also questioning going forward, and here they say they already did 30 million in July on top of the 110 million. That means that the management really likes doing buybacks here as the best return of value for shareholders. However, given the frozen food sentiment, we'll discuss Conagra Brands next week. It's not stellar, it's not growing at 50-100% like AI is, so it's pretty shunned by the market. As the stock goes down, the analysts need to lower their targets, that's standard, and a reversal is not seen. But value investing is about, am I liking what I see without the reversal? Let's leave the reversal potential for just the potential as a bonus for investments. So execution risk, if we ask ChatGPT, mid-tone, there is risk. When will this happen? Valuation is cheap. Guidance, sentiment, momentum. If I look at the articles, for example, on Seeking Alpha, as the stock is down, everybody is negative, but let's make a valuation. If we look at things, free cash flows have been always there, always strong. And these are the inputs for our intrinsic value calculation. Let's even assume no growth or 2% growth on inflation, 200 million euro cash flows, buybacks, dividends. Just buybacks is 5% growth per share. By the way, here you can see my portfolios, the premium intrinsic values calculation and everything. I don't own Nomad, at least not yet. But if we go to our free value investing for life course, you have there the intrinsic value template that you can download, and I have already included Nomad. So here is our little Excel template, intrinsic value, and here is Nomad Foods. I'll put here in Excel, Nomad, and I have put free cash flow, let's say 160 per share, euros. We're talking euros here, so that's then also to be changed with the dollar, which is a little bit weaker, dividend payout ratio 50%, and then with just 2% growth rate over time, let's say that people just stably keep eating their frozen food, frozen potatoes, which is the new invention with protein likely, well, even then, we are now at a fair intrinsic value for a discount rate of 10%, so expected return of 10%. If the growth rate is 5% in the best case scenario, then the present value for a 10% or the target price in that case in the upside of 20. Worst case scenario, there is no growth, just keep getting the dividends, somebody buys it out somewhere, and then you are still not far. This is actually at the current level when you translate it to dollars. So 15 bucks would be an average 10% return there. If we go to the comparative table, you see here a positive, likely 11% return. Occidental, depending on oil, is also there. CNH Industrial on the cycle, they're a little bit risky cyclicals, but Nomad is among the best that we have discussed here over time. Of course, there are the links for the videos here if you want to see more. How does that fit our value quadrant? Well, on the reward side, and we have the risk side, given the private labels, given everything, as we are around 11% return, we should be here. But on the risk side, there is 2 billion of that, so I cannot put it here as a certainty. There are the private labels, it's not an easy market, but it is an interesting niche. So if you go for a group of these businesses, it might be interesting, and you will likely get your 5% dividend, 6-7% cash flow return, all in all accumulating from a basket there a 10% return, no matter what happens with AI and whether we eat chips or potato chips in the future. So when it comes to portfolios, when it comes to my personal portfolio, I miss that moat, that quality, that wonderful business that will make it grow to eternity. This is very management execution. They need to do the buybacks now as they are doing cheap, not high, things like that. That's something they are doing well, but there is not a structural positive tailwind. If this business would be in Asia at the same levels, that would be something pretty different. For the model portfolio on the risk, private labels, perhaps a little bit too much debt now for a price. Diversified, look at Conagra. Tomorrow we'll look at another stock. I have this month still to research. And then when I look at the diversified, I might add it in a few weeks. Of course, you can check all my portfolios on my research platform, my performance. We have done 15% over the last 7 years on value investing. If a value investing philosophy fits you, check it. Thanks for watching. I'll see you in the next video.